Good day, fellow investors. Stock analysis time. We have not discussed Daniels Midland in a while, and the trend has been negative there. But the valuations and the dividend look more and more attractive as the stock retreated from food exuberance times. And for those not familiar with Daniels Midland, it's a food processing company. So agricultural services, procure, store, crush grain, all seeds also same. They buy it, process it, and then sell it to further processed foods. In addition, they have nutrition, animal nutrition, flavor, specialty, etc. Footprint across the globe, depending on what of the three businesses we are looking at. And this is what will give a quick introduction to the company. If you look at the food cycle, when it's good they make okay, when it's bad they make little, normal, when it's great like it has been in the last few years they make a lot of money, but that is normal when it comes to food companies. A little bit more stability with the carbohydrate solutions, that is again a little bit now in Europe, some Asia, etc. But they also have nutrition they acquired, paid a little bit too much, but they also want there to get some more stability there. If you look at the numbers, facilities, procurement, context, whatever, and I think that people underestimate the value of this. This is built now. So with the inflation that we have had in the past, this is something that will drive, because you cannot replicate this for the same amount of money that ADM spent over time. If we look at the highlights, earnings per share are subdued a little bit, still good from the previous quarter, but the cash flows are still there, especially when we compare it to the market capitalization. They have announced 370th consecutive dividend, growing dividend for 50 years. They have done buybacks, completed the buybacks for this year. We'll see about next year. Okay, things are a little bit down as the food boom and inflation have slowed, but if inflation comes back, if food issues come back, then again this will be also a hedge to a portfolio from that perspective, because everything is already built and now building it costs much more. So profits down, carbohydrate stable, okay, cash deployment, cash from operations down, but they are always profitable. They have spent a lot of repurchases from last year. Likely next year will be a little bit lower because of the current lower profits, but the outlook are significantly lower for the agricultural part, slightly lower, and even higher for nutrition. The outlook is there. The guidance, $5.5 to $6 in earnings on a weaker, let's say, food environment, which still, if we look at their future estimations, we'll see whether it will be 6, 8. I can tell you it will range from 5 to 9. What will happen when? Impossible to predict, but they plan to do the repurchases, etc., etc. So, an essential business, an inflation protective business, food business, thus detached from all the shenanigans going around, and at a 10p ratio with a good dividend and repurchases. Well, if I look at the conference call, I read through it, and mostly questions that are relative to the company in the short term, so not really into that food long-term cycle. This doesn't really affect long-term investors, but they are completing the repurchases and increasing the dividend in short. If I put that into value investing process that we do on this channel, market cap, P ratio, okay, likely earnings will be, now the price is 60, let's say 5, so the P ratio maybe 4 next year will go to 15, but the dividend yield will remain there. Maybe there will be some buyback. So if I look at this from a long-term perspective, when you see such a chart, it's a clear compounder. And inflation, investing, etc. will continue compounding. You can play around by buying it when it's ugly, selling when there is clear exuberance like it was the case in 2022, but we are now then again, let's say, on the trend. If it goes to 50, I want you to notify immediately in the comments and let me know, okay, 50 cents, let's recheck it. But even now at 58, if I look at what they are doing and the earnings, yes, but 5, maybe it will go down to 5, maybe 4, which will be the time to buy because the infrastructure is there. I don't think we'll see the 2 again from 10 years ago almost. There have been 50 consecutive years of dividend increases that will likely continue. Thus, ADM is a very interesting business to follow. 58 average earnings, let's say 5, 6 with some growth. That's 10, 11, 12% returns for the long term. Dividend buybacks, it looks good. Okay, if there is something going on in the market, it will follow the market. Let's see if we can get it for 50, but it's already good. I cannot predict whether it will jump to 90 from this level, where it will go, but I'm just telling you it's something very interesting to follow. If you like it, if it's better than other things in your portfolio, it's also a very interesting buy. Thanks for watching, check what I do on my research platform, and I'll see you in the next video.